Ladies and gentlemen, Greg Mikulowski from ForexLive.com. I'm going to take a look at the sterling versus US dollar as we head into that key Bank of England interest rate decision tomorrow morning. We know tomorrow morning at 7 a.m. the Bank of England is going to announce their interest rate decision. There's a speculation as far as additional QE, maybe lowering rates as well, and all that may or may not happen. Ryan Littleson wrote a great piece on it. If you haven't read it, go to it. Here is the link right here. But what you need to understand about this is that there is a lot of risk going into this event, and from a trading perspective, regardless of what they do, we need to understand what technical levels are key. We saw earlier this week how the Reserve Bank of Australia cut rates. And what do we see happen to the Aussie dollar? It went down initially and then shot back to the upside and still remains nearer high levels from whence the interest rate cut occurred. We saw last week the Bank of Japan add some more stimulus and also do some fiscal stimulus as well. And that didn't help weaken the currency. We saw the yen get stronger, as a matter of fact. And so we have to be prepared for anything, especially in these summertime markets where liquidity conditions are light. So I'm looking at the 4-hour chart here in the sterling versus US dollar. And what sticks out to me in this 4-hour chart and why I'm going to focus on it through as the source of key levels is that the price is trading in between some two key moving averages. One is this green line, which represents the 200 bar moving average on the 4-hour chart. And the other one is this blue line, which represents the 100 bar moving average on the 4-hour chart. And the market price is more or less right in the middle of those two extremes. How convenient. The market has set itself up to either go to the upside or to the downside. And depending upon what the Bank of England does, should determine whether or not we break to the upside or we break to the downside. In traditional markets, we would expect that if they do increase, QE or ease credit conditions, cut rates, we should see the pound versus US dollar head to the downside, in which case we would be breaking what? Breaking that 100 bar moving average, breaking this level right here and moving to the downside. If they were to keep their powder dry and not do anything, what would we expect? We'd expect the price to move above the 200 bar moving average and explore upper regions or upper levels. So those are the two key levels where action should send the price toward. With the price at 133.13 now, we're about 100 pips away from the lower extreme at 132.077. That's the 200 bar moving average on the 4-hour chart. And with the price at 133.13, we're about, a little less than 100 pips, about 80 pips or so away from the 134.02 level, maybe a little more than 80 pips, if my math is correct, like 90 pips away from the 200 bar moving average on the top side. In addition to that moving average on the top side, that 200 bar moving average, we also have this trend line. This trend line connects the recent highs, and it cuts across right where the 200 bar moving average comes across as well. So that too is going to lead to a level that the market will pay attention to right here, and so gives us extra confidence that a break above that level leads to higher levels. Now on the top side, if we do break above this level, what do we look toward next? We're going to be looking toward the 100% retracement of the high corrective price after the Brexit. Okay, so this is the high price after the Brexit. The market, this is the low price after the Brexit, and the market price would look for a move toward this level right through there. A break above that level, and it opens up the door for further upside. In fact, I'd be inclined to put a Fibonacci retracement from our high price to our low price right here, and measure out the 38.2% retracement of that move, and target this level right here, 136.41, on any sort of break above the 100 bar or above the correction or the high price from the Brexit, and move up toward that 136.41 level. So that is how I see the upside developing for the sterling versus US dollar if we do have a situation whereby the Bank of England does nothing, or says that the economy is doing okay, so on and so forth, and they're going to wait on their policy. Now, on the downside has a number of different levels to consider. And one thing that you have to consider as well that Ryan pointed out is that a lot of damage has already been done to the pound sterling here. We're down in the 130s. That's a low level. We did go down to 128 level through here. And so there is room to head on back down toward that level if we really wanted to. But this, from 150 down to about the 130 level is a pretty big move that should be similar to the economy. So I know he's looking for an opportunity to buy a longer-term dip. Now that may or may not pan out. I would be cautiously bullish, especially if the price were to move below this 100-bar moving average. Why? Because we have these lows through here, right? Where the market held that 100-bar moving average. So a break below that level would be more bearish from a technical perspective. It just is. And so we would say you're not supposed to be long there. In this area because we fell below that level. Now, where might you think about buying the market if the market should break lower? And you could try to buy against this 100-bar moving average, but if it goes below that level, get out. Another level to consider would be this level through here. This yellow area. Why? Because if we take a look at the past here and look at that high right there, look at these lows through here, here. Lots of reasons why the market should be bullish above, bearish below at this level. And so if the price were to go down to that level, find support against that level, there is that possibility that Ryan may be right, that the market may find a bottom right here, move back above the 100-bar moving average, and then rocket higher, similar to what we saw in some of the other currency pairs where we saw the initial move and then correction back to the upside. So as a trader, we just have to pay attention to these levels. We have to follow them. We have to know where they're at. And if we know where they're at, we have the ability to react to them after the fact. And if the market does hold, if you're able to buy down here with a stop below the yellow area, your risk is limited and your potential reward could be great. All you need to do is get back above that 100-bar moving average on the 4-hour chart, and you have a multiple of the risk on that trade already. At this point right here. So be aware of these levels, understand where they're at, understand, have a plan, and if the plan doesn't work, get out, okay? If you want to buy a dip and the market goes below this yellow area, don't stay in. It's not telling you the right things, and the market price is never wrong. It doesn't lie. My name is Greg Michaelowski. If you like this video, give it a thumbs up. If you didn't like the video, give it a thumbs down. Tell me why. I love your feedback. Bye-bye now. Good fortune with your trading.